Well, let's turn our attention to the hotel space then. In a recent report, Elara Securities says that various unforeseen events have dented occupancy in the first quarter of FY26. But they believe that Q2 onwards, things will continue to look up. Prashant Biyani, the Vice President, Institutional Equity Research at Elara, joins us on the show. Hi, Prashant. Good morning. Good to see you. Well, Q1 is going to be a little bit softish. What are you penciling in terms of occupancy, in terms of, average prices out there? And what kind of a recovery do you look at from there on?
So Q1 will be strong, but it will be the growth will be lower than expected. We have seen occupancies getting impacted due to geopolitical tensions as well as travel disruptions led by Air India flight crash. So that has dented some of the occupancy, but still on a YOY basis, we see growth both in occupancy as well as ADR front. So on RevPAR basis, we are expecting 12 to 14% growth in Q1 for the industry. Q2 onwards, we would be on a normal base. On the occupancy front, we are expecting flattish kind of occupancy from Q2, but ARR trajectory continues to be strong. So I believe hoteliers will continue to clock RevPAR growth in double digits. The focus of the hoteliers now have shifted on RevPAR. Either it comes through occupancy or through ARR. That is not a matter for them right now. It is what RevPAR is on which they are focusing on.
So, Prashant, from what you say, it seems that the first quarter perhaps was just an outlier, just an aberration because of the unfortunate events with the crash and the cross-border tensions as well. Now, since you seem to be convinced about the overall growth trajectory, the longer-term narrative on the hotel space. So from that perspective, for someone who wants to get in with at least a 1-2 year view, which company could perhaps offer the best growth and valuation comfort, synergy? There's obviously Indian hotels, but should you be looking at tier 2, tier 3, smaller hotel stocks? If you've missed the big move on Indian hotels itself?
See, structurally, we like IHCL.
Oops. I think we've just lost that line with Prashant. We'll get him back, but that's the
brand base and Chalet Hotels in asset owner space.
Yeah, Prashant, we lost you in between. Can you start that answer again? Your favorite hotel stocks and why?
Yeah, so structurally we like IHCL as well as Chalet Hotels. IHCL because of the fact...
I think we have a bad line.
They have a leading pipeline. And then on Chalet Hotels, again, we are expecting asset addition every year from Chalet Hotels for the next 4 or 5 years. So these two are the preferred ones right now. And given the kind of run-up that we have seen in business for all hoteliers, valuations are not cheap as of now. So that is why it would be better to focus on stocks which are good from a structural perspective.
And you've listed those names, Prashant?
IHCL and Chalet, just two, right?
Yes.
Right. So at the margin, valuations are not cheap, but at the margin, do you expect, the general broader expectation is that consumption will pick up, but I guess that is largely for mass market, which has been doing poorly. There's been no such problem at the higher end discretionary, right?
No, in hotels, actually, we are seeing demand across all segments, be it luxury, upper upscale, mid-scale. So it is not that only the luxury or the top-end segment is seeing demand growth. We are seeing it trickle down to even the mid-scale segments. So companies like Lemon Tree, Sami Hotels, right up to IHCL, all of them are seeing good occupancy as well as rate growth.
Yeah. There's no, I ask this question whenever we speak with the hotel company once in a while, but, what is worth doing is worth overdoing. That's the general maxim in markets. There's no risk of overbuilding, right? I mean, the last time you had a big boom in hotel construction, it was long ago, but it took 15 years for that capacity to be absorbed. No, is there a risk of that same repeating?
Right. See, the difference between asset addition in the last upcycle and right now and for this upcycle is that between 2008 and 2014, the expansion primarily was in business locations. But this time the expansion is in your not only in business location, it is well distributed across business as well as leisure locations. It is not concentrated to tier 1 locations. It is spreading across tier 2, 3, 4 locations as well. And that is why therein lies the key difference. Rather in tier 1 location, actually the construction has been less because of the expensiveness of the of the hotel construction, and that is why we are seeing ADR growth in most of the metro locations in double digits. It is a classic demand supply mismatch which is playing out right now. So I don't think that there is a similarity between the last super cycle of asset addition vis-a-vis this time. Actually, by 2030, we should see ideally almost all prominent locations across tier 1, 2, 3, 4 having one or two branded hotels, which will be the key difference between this asset addition cycle versus the last one.
Okay, there's an interesting point there. Prashant, thank you very much for joining us. It's good speaking with you and getting that perspective. Patchy line, I wish the line was better, but interesting conversation nevertheless. Well.